In the world of financial reporting, clarity is paramount. Investors, creditors, and other stakeholders rely on accurate and transparent financial statements to make informed decisions. This is where Accounting Standard 1, Disclosure of Accounting Policies, takes center stage. Issued by the Institute of Chartered Accountants of India, AS1 provides a framework for companies to disclose their accounting policies, ensuring consistency, comparability, and understandability in financial reporting. Imagine trying to compare two companies, one valuing inventory using the first-in, first-out method, and the other using the weighted average method. Without knowing the accounting policies used, such a comparison becomes meaningless. AS1 bridges this gap, requiring companies to clearly articulate their chosen accounting methods. This transparency allows stakeholders to understand the basis of financial statements and make informed comparisons between companies and across reporting periods. AS1 is not just about listing accounting policies, it's about providing insights into the company's financial decision-making. By understanding the why behind the what of a company's financial reporting, stakeholders can gain a deeper understanding of its financial health and performance. AS1 revolves around several key principles that ensure clarity and consistency in financial reporting. These principles act as pillars, supporting the edifice of transparent financial reporting. Disclosure of significant accounting policies. AS1 mandates the disclosure of all significant accounting policies adopted by an enterprise. This includes methods used for inventory valuation, depreciation calculation, revenue recognition, and more. Imagine a company switching from the straight-line method to the accelerated method for depreciation. This change, if not disclosed, could significantly impact the reported profits and asset values, misleading stakeholders. Consistency. Consistency ensures that the same accounting policies are applied consistently from one period to another. This allows for meaningful comparisons of financial performance over time. If a company changes its inventory valuation method, AS1 requires disclosure of the change, its justification, and its impact on the financial statements. Materiality. Materiality refers to the significance of information. AS1 acknowledges that not all information is equally important for decision-making. Companies are required to disclose only material accounting policies, meaning policies that could influence the decisions of users of financial statements. Prudence. Prudence encourages a degree of caution in financial reporting. It emphasizes the importance of not overstating assets or income and not understating liabilities or expenses. This principle helps ensure that financial statements present a realistic and not overly optimistic view of a company's financial position. Substance over form. This principle emphasizes the importance of reflecting the economic substance of transactions over their legal form. For instance, a lease agreement that effectively transfers ownership risks and rewards of an asset to the lessee should be treated as a finance lease, even if legally it's an operating lease. To better understand the practical implications of AS1, let's delve into some specific examples of disclosures required under this standard. Methods of depreciation. A company must disclose the method used for depreciating its fixed assets, such as straight line, declining balance, or units of production. Each method can significantly impact the reported depreciation expense and the carrying value of assets. Valuation of inventories. Companies must disclose the method used for valuing inventories, such as first in, first out, weighted average, or last in, first out. The chosen method can influence the cost of goods sold, impacting the reported profit. Revenue recognition. Companies must clearly outline the criteria used to recognize revenue. For instance, a company selling products might recognize revenue at the point of sale, while a company involved in long-term construction contracts might recognize revenue using the percentage of completion method. These are just a few examples of the numerous disclosures required under AS1. The specific disclosures may vary depending on the nature of the business, industry practices, and the complexity of the transactions involved. AS1 plays a pivotal role in enhancing the transparency, comparability, and decision-making utility of financial statements. by mandating the disclosure of significant accounting policies. AS1 allows stakeholders to gain a clearer understanding of transparency. AS1 promotes transparency by removing the guesswork from financial reporting. Stakeholders can clearly see the accounting methods used, allowing them to understand how financial results are derived. Comparability. By providing a standardized framework for disclosure, AS1 facilitates comparisons between companies and across reporting periods. Investors can compare the financial performance of companies using different accounting policies by understanding the adjustments required to bring them on a comparable basis. Decision-making. Informed decision-making requires reliable and understandable information. AS1 empowers stakeholders with the knowledge to interpret financial statements effectively, leading to more informed investment, lending, and other financial decisions.